There are millions of commercial insurance policies in force in America, and this segment of the industry requires significantly more knowledge and expertise of the producer to become proficient in these lines. We started with a broad look at commercial insurance packages. We detailed the different components of a commercial policy package, or CPP, as well as insuring agreements. We also introduce you to inland marine coverage. Commercial insurance is markedly different from personal lines coverage. For example, in a personal lines auto policy, the named insured receives a single declarations page detailing coverage, premiums, autos insured, and more. But in a commercial insurance package, there is a common declarations page, which is a compilation of all the loss forms and endorsements within the CPP, as well as individual declarations pages that detail the specific forms and endorsements. We first went through the Commercial General Liability, or CGL, contract. This policy may be written for almost any kind of business, but it alone probably won't cover all of a client's exposures. The CGL can be issued as a monoline policy, with it being the only contract in force, or it can be part of a commercial policy package. The limits of liability in a CGL have a different look to them. CGL contracts provide a per occurrence limit and an aggregate limit. Remember that a per occurrence limit is the most a carrier will pay for a single occurrence, and the aggregate limit is the most they'll pay for the entire policy term. There are also endorsements and additional coverages that may provide a benefit and may not be included within the policy's limits, and it's important that you understand and communicate this information to your client. Another concept that separates personal from commercial coverage is the idea of occurrence and claims-made commercial contracts regarding claims. An occurrence-based policy acts just like a personal car insurance policy. As long as the loss occurs during a policy period, coverage is in force. But with a claims-made policy, not only must the loss occur during the policy period, the claims must be reported to the carrier within the policy period as well. That could cause a problem if the claim isn't discovered until the next policy period. This is why commercial contracts have extended reporting periods. This provision allows the named insured to file a claim after the policy period has expired. It doesn't extend the coverage period, though, only the time allowed to make a claim. The lesson continued with topics like retroactive dates within commercial contracts, coverage for premises liability, products and completed operations coverage, and pollution coverage. About 85% of all commercial insurance is for smaller companies, so it's not just for office buildings and large complexes. Small businesses that encounter losses can be impacted more seriously than big businesses, and cash flow concerns are a huge issue in case of a business interruption. Smaller companies don't generally have the cash on hand to wait out financial storms the way larger companies might. The base concepts of the forms and levels of coverage are generally the same between commercial policies and dwelling or homeowners contracts. We discussed the idea of packaging a commercial insured's coverage needs, and that these are contracts that, in a sense, mimic a buffet line. Your client can pick and choose which endorsements work for them. Depending on the type of business, crime forms provide peace of mind to a client, especially those with higher-end products for sale, keep considerable funds and property in a safe or other container, and for exposures like burglary and robbery. Remember that one of the bigger concerns regarding crime isn't the public, but losses caused by employees. Crime coverage is easily tailored to just about every insured's needs, but it must be included in the package. The next section of the course covered inland marine insurance. Inland marine is intended to cover modalities of transportation and property contained in them. Inland marine contracts can protect many different exposures. Floaters can cover everything from simple personal articles to bridges, tunnels, piers, even broadcast towers. We also discussed the importance of equipment breakdown coverage and how it might apply in the event of a loss. Equipment breakdown coverage can be a critical part of any package issued to a manufacturing business and could save a company from financial ruin. Then we took you to farm insurance. Farm contracts, like other commercial policies, are typically built as a farm combination policy. Some farms are simple in their makeup, maybe a small barn to keep the horses, but others can be massive and complex operations that require much more in terms of endorsements and limits. These policies are based on the same forms you've already seen: basic, broad, and special. Farm policies have coverage shown through the letters A through G for the property portions. The liability portions included in a farm policy include bodily injury and property damage, personal and advertising injury, which is not found in a homeowner's policy, and medical payments. There are also dozens of endorsements that can be added to a farm coverage to design a policy for a particular client's needs. Study the information, as it is important, and there can be subtle differences in the conditions and exclusions. How you take care of your clients is one of the cornerstones of your insurance career. Congratulations! Once you finish this segment, you'll have to pass an examination on the material you've just learned with a score of at least 70%. Don't worry, if you don't pass, you have unlimited opportunities to try it again. Thank you again for choosing At Your Pace Online, and remember, we're always here to help if needed.